A very interesting development that's taken place in infrastructure financing. IIFCL, which is India Infrastructure Financing Company, along with ADB and a few other partners, have successfully issued India's first credit-enhanced bond. To talk more about it, we're now joined by Mr. S.B. Nayar, the CMD of IIFCL, and Sumant Sinha of Renew Power Ventures. Good afternoon, gentlemen. Thanks so much for taking the time out, and many congratulations. Just to get into a few details. One, who will be giving the credit enhancement in these bonds? What's going to be the size of the current issue, and are you looking to issue more such bonds?
Yes, I would say from IIFCL point of view, we are definitely looking to issue more such bonds. The credit guarantee is 431 crores.
Yeah, 451.
451 crores, and IIFCL has given the guarantee with the backstop from ADB. And Renew Power is the first such customer who has come into the market.
All right. Hi, Mr. Nayar. Hi, Mr. Sinha. Thanks so much for joining in today. Could you give us a few more details then, Mr. Nayar? How much does the cost go up for an infrastructure company if it seeks credit enhancement? Is the cost viable?
Yeah, you see, cost is of course a very important factor, but cost is not the only factor.
Yeah.
Cost in this case, for example, actually depends on the current rating and how much guarantee has to be given to make it AA or AA plus. You know, in which case, in their case, probably the guarantee is about 28% of the bond issue. And the guarantee fee, see, they are getting about 150 basis points in terms of interest, but more than the 150 basis points, they also get a much longer tenor. Their equity IRR goes up, and their exposure limits to the banks come down, which means the banks can take further exposure to the new projects.
Okay, so just to understand this, IIFCL along with ADB will provide a guarantee to the tune of 38% of the total, bond value, and
28%.
28%, and
no, 28% in their case. Yeah, in their case.
In their case, 28%, and in return, you will be getting a 150 basis points of return.
The Renew Power will be getting the benefit.
So if I can just step in and clarify. See, the project was financed earlier by bank financing, and the loan amount, the interest rate on that was about 12%.
Okay.
By getting this credit enhancement from IIFCL, we are actually able to effectively bring down the cost of the borrowing in the bond market to 9.75%. And if I add the credit enhancement fee and so on and so forth, there is almost a 150 basis points reduction, or 1.5%, for the full 451 crores of maturity. But as Mr. Nayar was saying, that is not the only benefit, although of course it's a very important benefit. The other benefit we get is we get much longer maturities, and we get diversification of financing away from the bank market into the bond market, which is mutual funds, pension funds, and insurance companies, which have heretofore not really been able to finance infrastructure projects, simply because their credit rating requirements are very high. Typically, they're looking at financing projects of AA, AA plus, and so on. Whereas on a standalone basis, most of the projects are at BBB or thereabouts. So what this product does is it very importantly bridges takes the credit rating of the projects from BBB up to AA, AA plus, and gives us access to this new market, which has not up till now been investing in these sorts of projects. So therefore, this product is an absolutely critical one to really get many more different types of investors to come into this sector.
Okay, so multiple benefits. The credit rating has gone up. It's a longer term tenure. The cost is so much cheaper compared to what you could perhaps raise from the banks. But Mr. Nayar, coming back to you, how will you decide for which bonds or which companies will you be giving this partial guarantee? What will be the key criteria?
Basically, we look at brownfield projects. So once the project is up and running and they get a rating, the rating agencies will, first of all, we need to have a rating to enhance it. So rating agencies normally will give a rating once the project is commenced operations. So depending on the risk profile of the project, we do a regular property appraisal, and we can't obviously enhance every single project, but we do approach a really professional way. We do a credit and appraisal and see the viability of the project. We analyze the risk factors and then decide on the credit guarantee.
All right, Mr. Sinha, then let's come across to you. Do you see a viable market for infra players to come in there and raise funds anytime soon, or do you think it will be condemned just to bank financing of infrastructure?
No, I think, see, the current, most of the lenders are bank lenders simply because, they are the ones who are able to appraise these projects and give the long-term financing that is required. But frankly, it leads for them into asset liability mismatch issues. And therefore, for infrastructure financing, if you're only dependent upon the bank market, that's always going to be providing some sort of a constraint. Now, the problem in India is we don't have a credit market. In other parts of the world, you have a very credit-sensitive market which rates all the way from AAA all the way down to junk bonds in the single B category. And there are different pricing levels for all of these. Unfortunately, in India, we don't have a very deep bond market, and all the players that are existing right now are really only lending at the very high end of the credit spectrum, which is the AA and AAA level. So I think. First of all, we have to, as a country, develop a much more vibrant and viable bond market, which will only be what is required to finance infrastructure projects more and more. Today, that doesn't exist. So it's only through instruments like this that we're able to access the bond market. And that, to me, is good up to a point. But ultimately, unless we develop the bond markets more fully, you're not going to be able to get a lot of infra financing happening through the bond markets. And that is always going to be a constraining factor for infra financing. Because the needs are large and the investor base is small, unfortunately.
I just would like to add to what Sumant said, because the banks in India have been primarily financing infrastructure so far. But going forward, that will not happen because, various factors. The banks are relatively smaller. They are reaching their sectoral caps. They have the NPA issue. They have Basel III coming in, which will, discourage them from taking exposure to unrated projects because the capital cost will be very high. So all these, with all this, the same kind of enthusiasm may not be there for financing infrastructure projects. It's obvious that our requirements for infrastructure lending will be much greater than what we have done so far. So to meet these requirements, we need to develop bond markets, and this credit guarantee probably is one of the steps, the first steps to do this. I really sincerely hope this will help us develop this market too substantially. Another thing, of course, one more requirement for this is also a market maker. We need to have institutions which will actually buy and give a two-way quote for these bonds, because many of the investors actually would come in if there is a two-way quote. Okay.
Mr. Nayar, right now you said the size of the current issue is 451 crores, which you've given to, Renew Power. But you will look to issue more bonds. What's the total size of infrastructure funding that you're looking to tap via these credit-enhanced bonds, say in the next few years?
We don't have a specific target like that. We would like to look at available projects where we can do this, and within, we have certain norms, like we can do a certain percentage of the project, and our capital, our percentage of our own net own funds, etc. So I would like to look at any good project where we can do this.
All right, Mr. Nayar, then
it also depends on the investor interest also. Yeah.
Okay. So, Mr. Sinha, coming to you, who would be the potential buyers of these bonds? Who are you looking to sell it to?
Well, these bonds have been underwritten by IDFC, and the intent of IDFC, as I said earlier, is to sell it to mutual funds, to pension funds, and to insurance companies. And typically, as you know, insurance companies and pension funds have very long-term liabilities, and so therefore they can also create long-term assets that allow them to match the tenor fairly well. So I think that is the market that we'll be looking to sell these bonds into.
In fact, one of the purpose of this credit guarantee is, partial credit guarantee, is to bring those people who would normally not come into project financing into the funding.
All right, Mr. Sinha, then putting this question across to you, then we have a very poor legal system, so bond defaulters, they can't really be made to pay up. How much of an impact can this have, given that the legal system is quite poor currently?
No, I don't think it's very poor. I think that there is a fairly robust framework, and I think that in case of default, there are recourses that the investors have. But I think ultimately the best comfort that is going to be obtained by investors is the quality of the parent company, the quality of the promoters, as well as the quality of the project itself. And I think, especially in renewable energy projects, the good news is that once the project is set up, then and as long as the PPA is signed, then the project will keep performing, and the money is going to keep coming in from the PPA signer. And so therefore there is very little risk actually involved in these projects. Okay. And so actually it lends itself very well to long-term investors.
Okay. So, Mr. Nayar, you also indicated that perhaps we're going to see more products to meet the burgeoning needs of the infrastructure market. So, which are the new innovative products that we should expect now?
One of the things we are looking at along with ADB is a credit guarantee. You know, this is not a partial credit guarantee, a total credit guarantee. For example, you know, if in a partial credit guarantee, we normally do it after the project is completed. But when a large project comes in, you know, for example, the insurance companies or the pension funds don't come in because there's no rating. Now, if you have a credit guarantee corporation which can at least give partial part of the funding through a guarantee, you know, the banks are now finding it, you know, difficult to achieve the financial closure for large projects. So we can channelize the insurance and the pension money, partly at least, to achieve the financial closure right in the beginning of the project itself. And actually, most of the projects require money for implementing the projects at the project implementation stage. So this is what we are looking at it. We are not yet finalized. This is, you know, it's a concept stage.
All right, it's an innovative product and we need more of these. So thank you, Mr. Nayar, as well as Mr. Sinha, for taking the time out and joining and explaining